The markets are holding on to some gains this morning as oil prices jumped a bit higher, breaking the $50 handle. But as we approach the halfway point for earnings season and continue to see strength in the dollar, investors may need to brace for more volatility. Let's bring in David Lebovitz, global market strategist at JPMorgan Asset Management, for more analysis. And David, what do you make of the bounce in oil today? We're seeing companies like BP in their earnings report announce multi-billion-dollar cuts in CapEx. What does that tell you?
I think the outlook for oil is still depressed, but I think it's important for investors to take a step back and realize that we all became very comfortable with $100 a barrel oil, but that's not necessarily the base case. I think what we see right now is we've seen more production come online in the U.S. Global demand is a little bit weaker. That creates a supply and demand imbalance, and at the end of the day, that's what really drives oil prices. So although we've seen stabilization, and to your point, a small rise back above 50, I'm not sure that we're headed back to 100 right away, and I think that the 2015 outlooks from a lot of these energy companies reflect that.
All right, now even if oil prices move higher, what does that mean for the dollar? Will it stay strong given the weakening euro from the ECB stimulus and the Fed's plans to normalize policy?
Yeah, I think our base case for this year is that the dollar continues to remain strong. To your point, you've got the Bank of Japan, you've got the European Central Bank, and they're actively in the market devaluing their currencies, whereby we look like we're going to get a rate rise within the next 6 months or so here in the U.S. So, despite low oil prices, I think what's going on in the central bank arena is outweighing what might be going on when it comes to the more traditional drivers of currencies. So we do expect the dollar to remain strong. I mean, you have to keep in mind the U.S. economy is the only economy in the world that's currently matching expectations.
All right, let's talk about emerging markets. There was an article in this morning's Wall Street Journal that showed that investors moved some $18 billion into emerging markets in January. That's compared to the $11 billion that they put out, released from emerging markets in December. Is this a good opportunity now, given all the global uncertainty?
When it comes to emerging markets, I think there are two important considerations. The first has to do with the longer-term structural story. And if you boil down economic growth into two pieces, growth in productivity and growth in your labor force, that story is still intact in emerging markets. You have investment as a percent of GDP, which is well above what it is in the developed world. And furthermore, the percentage of the population in a lot of these emerging markets that's under 20 years old is relatively significant, again, compared to the developed world. So, I expect the long-term structural drivers remain in place. It could be volatile, and you layer on top of that valuations are cheap. So you have an attractively valued asset class in a world where those opportunities are slowly but surely disappearing, and you still have the same story that's been in place for the past 5 or 10 years. So for investors who can handle a little volatility, I think there's real opportunity in emerging markets, given where equities in particular are currently trading.
All right, David, we'll leave it there. David Lebovitz, global market strategist at JPMorgan Asset Management. Thanks for your time this morning.
Thank you.
I'm Scott Gamm, and you're watching The Street.